Are you noticing signals that inflation is starting to rise? We're experiencing significant inflation. It's a fascinating topic. We're hiking prices, after all. People are boosting our costs. It has gained acceptance. I mean, inflation isn't a major problem for anyone right now. Inflation has been a major concern and topic of discussion among individuals, businesses, investors, and politicians for the past year to 18 months. We'll be going through this in this video. Through a hierarchy of different investing categories and how they rank in periods of inflation. All of this according to Warren Buffett, who, at 91 years old, knows a thing or two about inflation because he's lived through it. I went through hours of interviews of Warren Buffett when researching for this video. All I ask in exchange is for you to press the like button seriously, that's okay, and if you haven't already, consider subscribing to the channel. Let's get started with the video. Cash is the worst investment to hold during an inflationary environment. Warren Buffett isn't the only investor that doesn't like holding cash during inflation. Fellow billionaire Ray Dalio has also been vocal about his dislike of cash with a very memorable and kind of catchy quote: "Cash is trash." This is because during times of inflation, cash that you have sitting in a savings account or in your dresser dormant home is becoming worth less and less every day, every week, every month, and every year. One of the biggest takeaways I want you to take away from this video as an investor. You should consider your investment returns in what is known as real terms. Calculating your true return on investment is a simple process. Assume your investments increased by 10% per year. That's fantastic. Right? Not so quickly. It really depends on what the inflation rate is. In order to calculate the real return on your investments, you need to subtract out the impact of inflation. So if inflation is 7% and your investments return 10%, that year, your real return is only 3%. It's not nearly as thrilling. Right? This is why money is at the bottom of the food chain. Because the return on storing cash is nearly nil. When you keep currency for a long time, the effects of inflation work against you. Fixed interest rate bonds are above cash on the hierarchy. These investments are often thought to be quite safe by traditional investing wisdom, but Buffett would argue that they aren't all that safe when inflation is taken into account. Let me explain what I mean. The current yield on a 10-year US government bond is around 1.8%. As of the making of this video. This means that if you were to purchase a 10-year government bond today, you would effectively lock in a 1.8% annual return every year for the next decade. Let's say that inflation averages 4% over the next decade, which isn't necessarily stretched given that the most recent inflation report had inflation at 7% with 4% inflation. This means you would have an annual real return of negative 2.2% after you factor in the impact of inflation on your return. Now this is still better than just holding cash, but it is still a long way from the best. You know, if we dropped $1 million of cash into every household in the United States today, everybody feel very good except the people that invested in things that were denominated in dollars. And it's important to note that people that own fixed rate debt like government bonds lose during times of inflation. On the flip side, people that borrow money in the long-term structure at a fixed rate are winners during inflation. An example of this would be people that use a mortgage to buy a property in December 2020. It's not nearly as thrilling. Right? This is why money is at the bottom of the food chain. Because the return on storing cash is nearly nil. When you keep currency for a long time, the effects of inflation work against you. Fixed interest rate bonds are above cash on the hierarchy. These investments are often thought to be quite safe by traditional investing wisdom, but Buffett would argue that they aren't all that safe when inflation is taken into account. Dollar worth less and less, I get to repay my mortgage debt with the value dollars if you own a home, though with a very large mortgage and you have incredible inflation that wipes out the mortgage and you still got the home. I mean, it's just in Weimar, Germany they gave you the mortgage back at the end. It was very interesting. That's the one thing that is right next up on this hierarchy is what Buffett refers to as unproductive assets. These are things like gold, silver and other precious metals. Now, these aren't terrible to own during a period of inflation because all else being equal as the price for everything else rises, these things should at least keep up with inflation. In theory. However, these unproductive assets also won't likely increase your purchasing power either. Let's take a look at Warren Buffett's explanation. This is what I'll say about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So, if you took all the gold in the world, You could build a cube that was 67 feet tall and 67 feet wide. That would be the end of the story. Now for that same cube of gold, it would be worth in today's market price is about $7 trillion. That's probably about a third of the value of all the stocks in the United States. So you can have a choice of owning a third of all the stocks in the United States, or you can have a choice of owning that little block of gold which can't do anything but kind of shine there and make you feel like minus increases or something of the sort. Now for $7 trillion. There are roughly a billion acres of farmland in the United States. They're valued at about $2.5 trillion. It's about half the continental United States is farmland. You could have all the farmland in the United States, you could have about 7 ExxonMobils, and you can have $1 trillion of walking around money. And if you offered me the choice of looking at some 67 feet a cube of gold and looking at it all day, I'm not touching it for fondling it occasionally, and then saying, do something for me, and it says I don't do anything, I just stand here and look pretty. And the alternative to that was to have all the farmland in the country, everything cotton, corn, soybeans, 7 ExxonMobils. Just think of that at $1 trillion of walking around money. Maybe call me crazy, but I'll take the farmland of the ExxonMobils. Let's move on to the next category of investments in our inflation hierarchy. Now these investors don't just want to keep up with inflation. We want investments that can outperform inflation and that produce a real return for us. Here's where what Warren Buffett refers to as productive assets enters the picture. Now we all know that Warren Buffett made his fortune buying stocks and entire businesses. But according to Buffett, not all businesses are created equal. Next up in the inflation hierarchy is productive assets. Average businesses. Average businesses have a couple of characteristics, one of which is that these types of businesses require a ton of additional capital. Let's take a look at Warren Buffett's explanation. This is what I'll say about gold. If you took all of the gold in the world, it would roughly make a cube 67 feet on a side. So, if you took all the gold in the world, you could build a cube that was 67 feet tall and 67 feet wide. That would be the end of the story. So, here's a simplified example using a real company that will hopefully prove the point. United Rentals. Ticker symbol U. RE is the world's largest equipment rental company. They have a pretty simple business model. United Rentals buys equipment typically used in construction projects, so things like bulldozers, portable restrooms, and heavy-duty trucks. United Rentals then turns around and runs out that equipment to construction projects over the short term, usually the length of the project. Obviously, this equipment that the company United Rentals rents to its customers doesn't last forever and needs to be replaced every few years or so. Let's say for simplicity purposes each bulldozer the company buys cost $1 million bulldozer. It can be rented out to customers and produce $1.2 million in revenue for the business. That's a tidy profit of $200,000. But let's pretend inflation is 20% for the sake of this illustration. This means that the corporation will have to spend $1.2 million the next time it buys a new bulldozer to replace the present one. Look at what's going on. The company isn't able to receive any money from the business in the form of earnings. All the money that United Rentals is earning in profits has to be poured right back into the business in order to purchase new equipment to replace the old equipment. Now I don't expect inflation to be. Hopefully, it will be approaching 20%. United Rentals is also a fantastic organization. However, this case exemplifies the difficulty that capital-intensive enterprises experience during inflationary periods. Before we go on to the next business trait to avoid, here's a little anecdote. During the period of inflation, Charlie Munger, Warren Buffett's business colleague and friend, said something that pretty much sums up what I said. Well, there are two types of good businesses, one where the entire reported profit just sits there, and the other where you have surplus cash at the end of the year that you can take out of the business. And the business will do just as well without the cash as it would have if it stayed in the business. The second business is one that reports a profit, but there's never any cash. It reminds me of the used construction equipment business of my old friend, and he used to say, in my business every year you make a profit and there it is sitting in the yard, and there are an awful lot of businesses like that where to just keep going to stay in place. There's never any cash. The next trait of average businesses that you want to avoid are businesses that don't have what is referred to as pricing power. The easiest way to clarify what I mean by corporations without pricing power is to discuss a company that does. When I consider pricing power, I think of the first company that comes to mind as Apple. Apple has such a loyal client base that many Apple customers are willing to pay whatever the company demands for its iPhone. If someone wants a new iPhone, they aren't going to buy a competitor's product simply because it is cheaper. Compare this to a company with little to no pricing power, where the customer's primary concern is price. Manufacturer's plain white t-shirts, that is all the company makes, just plain white t-shirts, no design or branding. This company has no pricing power because someone is just going to buy the cheapest white t-shirt they can find. This t-shirt manufacturer also has no ability to raise prices higher than its competitors because the second is, prices are higher than its competitors. People are just going to choose to buy the white t-shirts of this company's competitors. This company will struggle in an inflationary economy. The cost of materials to produce the shirts is rising, as is the cost of paying workers to make the shirts, and the cost of shipping the shirts to buyers. The only thing that isn't changing is the company's ability to charge for its clothing. Do you understand why inflation is so difficult for businesses that lack pricing power? Let's move on to the next level of the investment hierarchy. Let's term these investments. Productive assets, great businesses. I know, very clever name. Here's another example for you. Remember how in the earlier example we had the business that spent $1 million buying a bulldozer. Let's say instead that our friend John here uses that same $1 million YouTube to make videos. Just like in the earlier example, let's say that John makes $1.2 million, a $200,000 profit. Great. But wait, it gets even better. Let's say there is also 20% inflation in this example. This means that John is able to charge 20% more for his software this year than last year. This means that the $1.2 million, the $1.44 million in sales that John had last year has increased by 20%. But the good news is that John won't have to put any more money into the software company. He already owns the software and will just have to invest a little amount of money to upgrade and maintain it. A capital-intensive enterprise is the polar opposite of this. In the earlier example, this software business of John's would be what is called a capital-light business because the amount of cash John will have to keep reinvesting in the business just to maintain the operations and product of the business is very minimal. This means that John can actually take his profits out of the business and doesn't have to constantly reinvest his profits back into maintaining the business. Like in the earlier example of the equipment rental company, in order to find a business that performs well during inflation, you want to find pretty much the exact opposite of the mediocre business that we talked about earlier. You want to find a business with low capital requirements. These are businesses that don't have to constantly be reinvesting large sums of money back into the business to grow a lot of times. These are businesses with very strong brands, businesses such as Apple, Coca-Cola, or Buffet's very own See's Candies. Other examples of the kind of businesses that have low capital requirements are businesses that don't rely on owning a ton of physical assets like factories or physical inventory. So think of companies like Microsoft, Facebook, or other technology-focused companies. Pretty much any software company falls into this category, as once the software is created and the money is spent in building it, the reinvestment back in the business is relatively minimal compared to most businesses. The other key element of the company you want to own during times of inflation is pricing power. Now I'll be the first one to admit evaluating a company's pricing power is more of an art than a science. But here are some helpful things to think about. One exercise that I think is helpful is to think about how a customer would react if the company were to raise its prices by 10%. There are a few different reactions customers would have that fall in a spectrum ranging from don't care about the price increase, take my money please, to no way, I'm not paying that. During times of inflation, when prices are rising, you want to own stock and companies that are able to easily increase prices for their goods. We want to avoid investing in companies and commoditized industries that struggle to raise prices even during normal times. I want to end this video with some important advice from Warren Buffett, and you know, the best investment at all. I mean, if you're the leading brain surgeon in town or the leading lawyer in town or the whatever it may be, you don't have to keep re-educating yourself to be that in current terms. You bought your expertise when you went to medical school or law school in old dollars, and you don't have to keep reinvesting and you retain your earning power in current dollars. The best protection against inflation is to invest in yourself. If you're the best at what you do, whether you're the best mechanic, lawyer, dentist, plumber, or accountant, you make yourself immensely valuable to other people. The benefit of being immensely valued in the marketplace economy is that you essentially get to charge whatever you want for your services and your customers will be happy to pay it. So there we have it. I hope you enjoyed the video. As always, make sure to like this video and subscribe to the Investor Center because it is my goal to make you a better investor by studying the world's greatest investors. Talk to you soon.